Good morning. Thank you for joining us. We're here for a webinar on essential year-end tax planning for businesses. I'm Brian Potter. I'm a tax partner here with Danable and McKee.
And I'm Anthony Pokrentowski. I'm a tax senior manager at Danable McKee.
So I just want to point out that this webinar is being recorded and we will be sending out links to all the participants after the webinar. All right, so I want to take you through our general year-end tax planning process. This isn't tailored. This isn't cookie cutter for everyone. It's generally tailor-made and customized for each of the businesses that we work with. We generally provide year-end tax planning services to essentially all of our businesses that we work with. As noted, the earlier we can do this, generally the better the results and more control over things we're going to have. Generally, information we're going to ask for is your year-to-date internal financial statements, any internal projections you may have for year-end, current year fixed asset information, equipment purchases, vehicles, improvements, any information on any extraordinary items that may have happened to point out to us and talk about in our year-end meetings, and importantly, any potential future year projections or expectations, so we can plan out maybe not just this year, but a multi-year scenario with you. So what are we going to do with that information? So generally, we're going to take your information, we're going to review your internal statements and do essentially a mini close for year end for them. We're going to adjust for your book income, adjust depreciation, any prepaids, accruals. We're going to take your projections, determine your projected book income for the year. Then we're going to calculate all the various tax adjustments to convert your book income to taxable income for the year. If you're a pass-through entity, we're going to take those projections, run those through the shareholder or partner returns, calculate the estimated tax that's going to be due for those partners and shareholders. And this is what we call the as-is projection. So if we do nothing, but let the year naturally end, that's going to be what the as-is, this is what will happen. This is what we're going to base our projections off of. This is what we're going to, sit down with you and talk about what strategies, opportunities we're going to have to either lower your income and tax burden or potentially do some other types of strategies based on that multi-year strategy. Based on that, we're going to sit down, have a meeting, finalize our projections, send you a nice package, outline that multi-year scenario, and talk about that as is, what we can do to lower or increase income and modify your tax burden at your end. So why is this important? Well, it's going to help you have control over your income to some extent. So generally, if we do this early, if we're seeing your financial statements for the first time in February or March, generally speaking, it's too late to do anything meaningful that's going to impact your taxable income or tax burden. And so the earlier we can get going on this, the better. At a bare minimum, this is going to prepare a company and owners for the cash flow requirements for their income tax for April 15th. So we're going to give you a kind of a roadmap that's going to lay this out, 4 to 6 months in advance. So you're going to know come April 15th exactly what you're going to be facing. And it also provides companies with a specific plan or strategy to follow, a kind of a budgeting thing to follow for year end to make sure we're on track. So getting into some specific strategies and topics. The first item on our agenda list, I was excited. I was going to tell you about this great new tax bill that passed. It's HR 7024, the Tax Relief for American Families and Workers Act of 2024. So that was the first agenda item. So I kind of led into a little disappointment that we're going to have here. But this bill, which was a House of Representatives bill, was a bipartisan bill. It was created on January 16th of 2024. The government does nothing quickly, but 15 days later, it passed the House of Representatives on January 31st by a vote of 357 to 70. I think that's very important. It shows that it had tremendous support on both sides of the aisle. We were expecting a quick Senate vote and a signature into law. And then unfortunately, some politics happened and it kept getting pushed down the road. Fast forward to August 1st, 2024. And after several months, the Senate did finally take up a vote where it failed the vote. So the bill was defeated. I don't want to spend a lot of time on what could have happened, but there was a lot of good that was going to benefit businesses in this bill. So it's going to increase the child tax credit, which is good for the middle and lower class generally. A big item, it was going to reinstate the immediate expensing of domestic qualified research expenses. So that's a big one. Anthony's going to hit on that in a second. It was going to reinstate 100% bonus depreciation. Later on, Anthony's going to walk you through what the current climate for depreciation is. It was going to reinstate larger business income expense deductions for anyone that's potentially limited for larger corporations. That would have been important. We have rising interest rates, so that could have been significant. And it was going to ultimately kill the employee retention credit program that's was great for some businesses, but there's been so much fraud in the area that the government essentially shut it down for a while, and they're looking to end this program. Highly unlikely we're going to get anything passed. Certainly not until after election time, but we're going to keep our eyes open for this and hope that some legislation does come out and pass here.
As Brian mentioned, how this was brought up by the House earlier this year and then kind of shot down by the Senate. This was actually something that we had thought was going to be passed a few years back when some of the expiring provisions of the Tax Cuts and Jobs Act were expiring that of 2021. We've been kind of hoping for 2-3 years now that something would come through to fix some of these changes that we're going to be talking about right now, actually. So the big one that Brian had mentioned is the research and experimental expenditures, which is under Internal Revenue Code 174. So back in 2017, the Tax Cuts and Jobs Act introduced many different changes to both corporate and individual tax laws. Among these changes was this delayed provision. So even though it was signed into law in 2017, this one didn't hit until years down the road, and was kind of just pushed out like, oh, they're going to fix it at some point. This was just a revenue raiser for the Tax Cuts and Jobs Act. But essentially what happened is beginning after December 31st, 2021, so tax years 2022 and forward, businesses were now required to capitalize and amortize their R&D costs, as opposed to being able to immediately deduct them in the year incurred. So these revised section 174 rules, like I said, require businesses to recover the capitalized expenditures over a 5-year period. Beginning in the taxable year, the expenditures are paid or incurred instead of the immediate expense as it had always normally been. If any expenditures are attributable to foreign research, the 5-year recovery period is actually extended to 15 years and has to be amortized over that 15-year period. Some costs that this entails are required to be capitalized include directly allocable expenses in the R&D activities, which are your labor costs related to R&D, the materials and supplies that you use or consume in R&D activities, any depreciation or amortization with respect to any property that's actually used in the R&D process and R&D activities, and any direct travel expenses that are related to the performance of R&D activities. Additionally, with IRC notice 2023-63, the IRS came out and said, on top of all those direct expenses, there are also certain selling, general, and administrative expenses that also have to be allocated to R&D activities and are included in that capitalization item that have to be amortized over 5 years. So that notice lays out a few specific expenses that are SG&A expenses that include rent, utilities, insurance, payroll taxes, real estate taxes, repairs and maintenance, employee benefits, and pension and profit sharing expense. So these indirect SG&A expenses have to be allocated to the R&D activities based on a cause and effect relationship between those actual costs and the R&D activities themselves, or any other relationship that reasonably relates the cost to the benefits provided to the R&D activities. The most common one that we use when we're preparing corporate returns that have required to have this add back is based on labor. So we take the total labor that is used and paid for that is in the R&D process and the R&D activities themselves, and divide that by the total labor payroll for the company for the entire year. Then we would take that percentage and multiply it by all those SG&A costs as a reasonable method of allocating those SG&A costs to R&D. An additional option that can be used, which it's not often used, I have used it on 1 or 2 clients, is the square footage utilized for the R&D process divided by the total square footage of the facility. So in that case, if you have 100,000 square foot facility, you use 5,000 square feet of space for R&D, we're only going to take that 5% of the SG&A expenses, like the rent, the real estate taxes, and apply it to R&D because it's only taking up that 5% space. And then, like I said, that ratio that we calculate there, either using the labor or the square footage, is then multiplied by those indirect costs to calculate the total additional costs that have to be capitalized and amortized. Just to run through a quick example, if company A has the following direct R&D expenses, they have payroll of $100,000 related to R&D, and they utilize materials and supplies of $50,000. Then they also have the following SG&A costs. They have rent, utilities, insurance, payroll taxes, real estate taxes, repairs and maintenance, employee benefits, pension and profit sharing, all those items I mentioned on the previous slide. So the last thing we'll say in the scenario is company A has total payroll of $2 million. So in order to calculate what we'll have to add back and capitalize and amortize instead of immediately expense, for the SG&A costs, we would take the R&D labor of that $100,000 divided by the total labor of the 2 million. So in that scenario, we have a 5% add back. So then we apply that 5% to all those previous SG&A costs that we listed out here. So when you add all of those up, that would come down to about $14,000 that would have to be additionally included in your IRC 174 expenses and capitalized instead of expensed. So that would bring us to total capitalized items or amounts of labor of 100,000, materials of 50,000, overhead of that 14,000 that we just capitalized. So total capitalized costs would then be $164,000, which those are all expenses that used to be immediately deducted. Now you're unable to, and you have to capitalize those and amortize them over 5 years. For the first year, you're able to amortize them over only a half year. They're considered placed in service as of July 1st of the year. So you get a half year of amortization. So you get 10% first year, then 20% for the next 4, then 10% the last year. So for this scenario, our first year amortization would be $16,400. So the total effect on your taxable income in this case would be an increase of $147,600. So as I mentioned previously, taxpayers were allowed to immediately expense those $164,000 of costs and also obtain an R&D credit of approximately $9,840 in that scenario. This resulted in total tax savings for a C Corp of estimated $44,280 by having R&D activities, by expensing them, saving on tax on the 21% rate on your deductions plus the R&D credit. That's a dollar for dollar against tax. The same scenario now in 2024 under IRC 174 would only result in tax savings of $13,284. So you'll still get that R&D credit of the $9,840, but then the only deduction you're going to receive is the amortization. So you only save on your tax rate times the amortization. So under this, your tax is actually going to increase by a little over $30,000 in this scenario due to IRC 174. What we have seen a lot is manufacturers have felt the largest effect of the IRC 174, but this does impact any business that conducts R&D activities. That is due to IRC 174 being completely separate from IRC 41, which is the R&D credit, which means businesses can't just simply ignore the R&D credit and say, we didn't do R&D this year, we're not going to claim the credit, so then we don't have an add back. That's not the case, unfortunately. You have to add back and capitalize the 174 costs, regardless of if you claim an R&D credit or not.
And he's right, we have seen a tremendous impact on, most of our manufacturers, this is a very crude, small example. Most of our manufacturers have numbers that are, 10 times the size of this. So we're adding millions of dollars to taxable income in a lot of cases. That's just, putting a lot of stress on cash flow under this law.
And it's essentially adding back phantom income because you're not receiving cash, you have to include it as income, but you're not actually receiving cash. You actually spent the cash, but you're not able to deduct it. So it's kind of a phantom income add back there. There is a large upfront cost to IRC 174 the first few years, but over time, the effect on taxable income should even out or potentially lead to additional deductions due to prior year amortizations. And that kind of depends on yearly how your R&D costs are going. If everything stays flat year by year for your R&D costs, after year 5, it'll be break even. The amount you have to capitalize and add back will equal the amount you amortize over the 5 years. If R&D costs increase every year, you'll still end up having to add back. If R&D costs decrease, you might have a deduct. But essentially it should even out after 5 years, but these first 3 years have been specifically rough on our manufacturing clients.
And the key takeaway for planning, and Anthony's gonna get into this later, is making sure, we're stuck with this 174 add back with these costs. We gotta make sure we're doing other things to reduce taxable income, but more importantly, maximizing the R&D credits that we can generate because of these costs.
And then we always get the question of, will these provisions be ratified or amended by Congress? Will there be any kind of exceptions for small businesses? Our answer is always, maybe, we're not sure. We've been hoping, we've been thinking would come along since 2021, 2022. There's always been optimism that Congress will have a workaround or eliminate this. But Brian has just previously mentioned, the law that actually got passed by the House got shot down by the Senate. So as of right now, again, it's uncertainty. This is the law the way it stands, and that's what we have to plan for 2024, 2025 and going forward.
So this brings us on to another deduction that we are heavily involved with the tax planning process. And it's been around since 2017 when the same Tax Cuts and Jobs Act was enacted. It's the qualified business income deduction. This is essentially a freebie, but it requires a lot of planning to make sure we're maximizing this. So what it is the qualified business income, QBI. It allows taxpayers to deduct 20%, up to 20%, 20% is the max, of qualified business income, plus 20% of some other certain income items, real estate investment, trust, REIT dividends that you may get with your investment income, and also certain publicly traded partnership income. Not available to C corporations. And in fact, this was created because of C corporations. C corporations got a lower 21% flat rate. This was enacted to kind of encourage or to kind of pay for these other companies that weren't C corporations to lessen their rates effectively as well, to level the playing field.
If this wasn't also included there, almost every single S corp we had would have raised their hand of wanting to switch to C corp.
That's
take
correct.
Advantage of those lower rates.
They would have been correct, most likely. So C corporations, this is ineligible too, and also it's not eligible to anyone providing services as an employee. So it's not available to anyone receiving wages or working in an employee capacity. QBI, important note here, QBI is available, it's an above the line deduction. So this is available regardless of whether taxpayers itemize or take the standard deduction. In fact, you get both. You get your QBI deduction and your itemized or standard deduction. This is one of these items that is set to phase out after 2025 when the Tax Cuts and Jobs Act expires. So this is really important that we make sure we're maximizing this income while this is still available. So what is qualified business income as part of this? So It's a deduction of 20% of income from a domestic business operation that operates as either a sole proprietorship, partnership, S corporation, trust, or estate. So it's essentially any entity that generates business income except for a C corporation. So it is subject to certain limitations, so it can't exceed 20% of a taxpayer's taxable income, but it's potentially also lessened by the type of business it is, specified service, more on that in a second, amount of wages that the actual entity itself pays, and the basis of some of its assets. Qualified business income does not include investment income, guaranteed payments, or wage income. It is strictly business income generated by the entity. I mentioned specified service trader business, and for QBI purposes, this is typically a bad thing to be. It's a group of businesses that the IRS created to lump you in. You can see here listed, it's in the field of health, law, accounting. Yes, that stinks for us. And consulting, a lot of professional service industries. Interesting, architects and engineers, they had a good lobby group. Apparently, they're excluded from this group. For an SSTB, they need to have wages or qualified property in order to qualify for this deduction at all. And this deduction actually phases out for SSTBs. You can see the limits here. So in 2024, if you're married filing joint, if your income hits 383,900, it starts to phase out, and actually at $100,000 later, 483,900, it goes to zero. So if you make $500,000, you're not getting any of this if you're in this SSTB category. The real estate investment trust and PTP components, as mentioned, you do get 20% of your dividends and publicly traded partnership income. There is no wage or property limit, but it is limited to that 20% of taxable income limit. A really quick, easy example here. So a taxpayer owns an S corporation. It generates $100,000 of ordinary business income on the K1. They also receive REIT dividends of $1,000 from their brokerage account. So this is the only income for the year. This taxpayer would get a deduction of $20,200, which is 20% of both of those components. It would lower the taxpayer's income from 101,000 down to 80,800. Very crude example, but essentially it's you're only paying tax on 80% of your income.
So now we're going to talk about the depreciation deductions. There are a couple different items on here we're going to speak on. The first is the section 179 deduction. For tax years beginning in 2024, the maximum section 179 expense deduction is $1,220,000. And that's just a certain equipment we can just write off right away under 179, depending on some limitations that we'll get into later on. That limit is actually reduced by the amount by which the cost of section 179 property placed in service during the year exceeds $3,050,000. So if during the year you place in service $5 million of manufacturing equipment, you're actually out of luck there for 179 because the deduction you're allowed of $1,220,000 gets reduced by every dollar that you go over that cap of the $3,050,000. So unfortunately, in that scenario, you won't be able to take advantage of 179. But that is just one note to be aware of there for this specific deduction. For property that qualifies, this would be tangible property, so your equipment, your furniture and fixtures. Certain vehicles, there are limitations that apply depending on the type of vehicle. And qualified real property, which are qualified improvements, roofs, HVACs, fire protection and alarm systems, and security systems. 179 is also limited to taxable income, so having a 179 deduction cannot create a loss on your tax return. One specific thing for the vehicles, if you have sport utility vehicles, SUVs, that limitation for 2024 is $30,500. The next item that kind of is the second option to section 179 is bonus depreciation. So under the TCJA, it allowed for the immediate expensing of certain property, but another caveat to that, it's starting to finally get phased out over time. So from 2018 to 2022, we were able to write off 100% of qualified property. There's no limitations, there's no taxable income limitations, there was no place in service limitations. We had certain property that qualified, we could write off 100% of the property. Starting in 2023, this is slowly phasing down 20% each year. So this year it was at 80% we could take. For 2024, we're only allowed to take 60%, and then 40% in 2025, 20% in 2026, and then down to 0 in 2027. So this is an important planning item because if in 2023 we had we're expecting 2023 we have to do the tax returns. There's a lot of fixed asset acquisitions, say put in service $1 million of fixed assets that all qualify for this. We got an $800,000 deduction. Say the same thing holds true for 2024. Well, we're only getting $600,000 in 2024, and you might not be aware of, well, income's gonna go up $200,000, even though nothing really changed on your business side of things. So that's an important thing to be looking out for, and that's something that we would look out for while we're doing year-end tax planning, to note that even though things stay the same on your end, we're actually not being able to take as much depreciation this year. So property that does qualify for bonus depreciation, so this is property with a recovery period of 20 years or less. This now also includes qualified improvement property, which originally was inadvertently left out. Which qualified improvement property is improvements made to the interior portion of a building that is non-residential real property if the improvements were placed in service after the date the building was first placed in service. And this does not include anything that enlarges the building, an elevator or escalator, or any improvements that have to do with the internal actual structural framework of the building itself. So a key point that we've done with previous clients are cost segregation studies. When you're doing a huge remodeling of a building, or if you're buying a new building that has a lot of fixtures, electrical, everything inside already, is doing a cost segregation study. So what this does is it assists taxpayers in allocating that purchase price of the building, or for allocating the price paid for all the improvements to lesser life assets to take advantage of those accelerated depreciation items that I just previously mentioned, if possible, rather than everything being grouped together and lumped into 39-year property, where again, it's gonna take 39 years to realize the benefit of that, when we could possibly bring it up to expensing it right away, or under bonus 80% of it, 60% of it right away.
I've done a lot of these studies with my clients. Typically speaking, we're probably gonna capture anywhere from 20 to 30% of the building's cost and be able to classify in one of those items where we can take bonus depreciation on it. So 20 or 30% is a big number on a, a multi-million-dollar building. So these are certainly worth doing and a great planning tool.
Yep. And just a quick example to show the benefit of this. If you purchase a building for $500,000 without a cost seg study, the taxpayer would roughly be stuck with a 39-year asset with $450,000 for the building. Plus, one thing to be aware of, you always have to allocate some part of that purchase price to land, which sometimes gets kind of forgotten, which is non-depreciable. So without a cost seg study, you'd have a $450,000 building that gets depreciated over 39 years, and then land of $50,000 that's not depreciated at all, which will result in depreciation deductions of only $11,500 per year, but for 39 years. If you do a cost seg study and say, like Brian said, we get 20% of that allocated to 7-year property, so $100,000, we're able to take $100,000 that qualifies for 179 deduction in year one. We have $100,000 deduction in year one right away. So that lowers taxable income in year one by almost $90,000. And then we'll depreciate the rest of the building over those 39 years.
All right. Switching gears here a little bit. One of the things we often look at when we're doing tax planning is to make sure that the company's method of accounting for tax purposes makes sense. So this slide is titled Maximizing Tax Deductions Cash Method. So a lot of companies, on their books at least, use the accrual method of accounting. So, and by default, a lot of manufacturers and general businesses will use accrual for tax purposes, but a lot of times it actually makes sense to make a change over to the cash method The IRS actually made it easier and a lot more businesses eligible to do this over the past several years. So we're looking at this with every client, with our planning scenarios. So what companies do qualify to be able to use the cash method? So qualified personal service corporations, entities such as, engineers, architects, accountants. So we got one in our corner on this one. They're able to generally elect cash method. And the other category is anyone classified as a small business. And this has been growing over the past several years. So any taxpayer, generally any taxpayer that has an average gross receipt, so revenue number, averaging less than $30 million for the past 3 years is eligible to make this change. So that's important. So $30 million or less, you're able to make this change. So that's grown significantly over the years. So if a company is on the accrual method of accounting for tax purposes, but would otherwise qualify to be a cash method, we're going to do this as part of our year-end tax planning analysis to determine, does it make sense to do?
Which Brian and I actually put this into place with a client this year. Of the past 3 years, we've had them, they've been on the accrual basis. Every year of planning, we do this analysis to see if it would make sense. It hasn't made sense year one of them as a client, year two. Year three, we look at it, they had a decent amount of income on the accrual method. We ran our analysis, and by changing to cash, we generated a loss for 2023. So with the returns this year, we switched them to the cash method, and it saved them a good deal of money there.
Yep, let's just take a quick example here. So you can see his company has a balance sheet in 2023 and 2 of accounts receivable, prepaid expenses, accounts payable, and accruals. So generally speaking, a quick little shortcut to this is if you're going to elect from accrual to cash, from accrual to cash, you're going to be able to defer your accounts receivable and prepaids. So in 2023, those total 220,000, and you're going to pick up into income your accounts payable and accrued expenses. Those total 100,000. So a real quick, very crude example, this client would be able to pick up about $120,000 of deductions if they switch to the cash method. And that can be seen here. The presentation and the tax calculations is a little different, but generally speaking, shortcutting to the answer, this taxpayer would likely benefit from a change to the cash method, saving $120,000 in taxable income. Going the other way, this possible scenario where the receivables went down, the payables went up. In this scenario, I'm just going to jump ahead. Our conclusion would be making the change would result in a pickup of $10,000 to income. Just based on this alone, it may not make sense, but based on other factors, it may. But this is the type of analysis that we're going to do in our year-end tax planning. So how do we make this change? So good news, it's a relatively straightforward and automatic process. So it's a form that we file with your company's tax return at year end after the fact. So by the due date you return, we file Form 3115 to elect and disclose these changes on a Form 3115 to make the change for tax purposes from accrual to cash. And your books are going to remain unaffected. They'll stay on the accrual basis. So under prepaid expenses are another tax item that we're going to look at for both cash basis taxpayers and for accrual basis taxpayers. It's one of these special items that you could potentially elect a cash method on even when you stay accrual as your overall method. So for cash basis taxpayers, general rule, you prepay a deduction, you're going to get it unless it doesn't qualify. So expenses that fall into that category, if they have a benefit extending past 1 year, an example would be a prepaid insurance policy, real estate taxes. So a lot of clients will advise them to prepay those big county tax bills that are due in January, reach back into December and make that payment early and generate that cash basis deduction. But you have to have the election in place or be on the overall cash method. Accrual basis taxpayers as mentioned, can make this election to actually be on the cash method for certain prepaid expenses. So for those insurance contracts, certain warranty contracts, real estate taxes, workers' comp, things like that, we can make what's called, if they pass the all events test, so the liability exists in the year of payment, we can make those deductions on the accrual method. So it's a great planning tool. We're gonna look at this, see if it makes sense, make sure all your elections are in place to be able to do this.
Then our last point on maximizing tax deductions is profit sharing contribution. So profit sharing contributions for a tax year are deductible as long as they're paid by the due date of the taxpayer's return, including extensions. So these won't have to be paid by 12/31. They can be paid as long as they're paid by the time you file your return. So this is another scenario where we'll look at it. Planning is if the taxpayer doesn't have the cash on hand right now to satisfy a profit sharing contribution, by the time a return is due in March or April, we may decide to extend that return until September, to allow them more time to bring in more revenue, increase their cash, to then pay it, but still get that deduction for the prior year, even though it's paid, say in 24, we'll still get the deduction for 2023. That's just another one. That's one of the only ones that you can pay kind of towards in the end of the next year before your return's filed and still get deduction for the previous year. Next, we're going to start talking about a few credits that are out there and available to companies.
Again, so credits, are these better than deductions? Oh, yes.
Yes.
So deductions reduce your taxable income and which your tax is calculated. Credits generally are a dollar for dollar benefit that reduce your actual tax. So valuing these credits are incredibly lucrative at times and can bring your tax liability significantly down, potentially to zero.
So the first one we'll talk about, one of the bigger ones, possibly the biggest one, is the R&D tax credit. So the R&D tax credit is a government incentive which was designed to reward companies for investing in innovation. It started in 1981, but became a permanent part of the federal tax code in 2015 due to its success in stimulating job creation and helping grow the U.S. as an economic leader. Which again, I'm going back to the IRC 174 costs. For why the credit was originally designed and brought out, the IRC 174 kind of cancels that out. It doesn't really help promote this anymore because of having to add back all those expenses in those first few years. But that's what the point of the R&D credit was originally, was to reward companies and invest in innovation in the US. The rules for the R&D tax credit are under Internal Revenue Code Section 41 and the related regulations. And it applies to any taxpayer that incurs expenses for performing qualified research activities. So what are the benefits of the R&D tax credit? So you can get up to 12 to 16 cents of R&D tax credit for every qualified dollar that is spent. You also get, it's a dollar, as Brian mentioned, dollar for dollar reduction in federal and some state income tax liabilities. New York, unfortunately, is not one of those states. You also have a reduction in your effective tax rate. You'd have improved cash flow, and say your credit is more than your tax for a year, that credit will carry forward for up to 20 years to offset future tax. What companies qualify? So the companies, in order to qualify for the credit, have to meet a 4-part test. The first item is elimination of uncertainty. The activity has to be performed to eliminate technical uncertainty about the development or improvement of a product or process. This includes computer software, techniques, formulas, and inventions. The second item is process of experimentation. The activities include some process of experimentation, which is undertaken to eliminate or resolve a technical uncertainty. The process involves an evaluation of alternative solutions or approaches and is performed through modeling, simulation, trial and error, or other methods. The third item is it has to be technological in nature. The process of experimentation has to rely on the hard sciences, which is engineering, physics, chemistry, biology, or computer science. And the last item is to be a permitted purpose, then, which is the purpose of the activity is to create a new or improved product or process that results in increased performance, function, reliability, or quality. Again, majorly this is with manufacturers, but other companies and industries do also qualify for the R&D credit too. Mostly though, we see it large R&D credits on the manufacturing side. So what are some specific qualifying activities? So this would be developing a new or improved product, process, or technique. You develop prototypes or models, or you develop, say, a unique assembly or construction method and process. There are specific excluded activities for R&D, which would include any research conducted outside of the United States. Again, this was implemented to promote United States, reinvesting in United States processes and inventing and trying to make new products, stimulate the economy. Any adaptation or duplication of any existing business components, market research, testing or development is not included, any data collection, ordinary testing, inspection for quality control, any surveys or studies related to the management function, market research or testing or quality control, any research related to social sciences, arts or humanities, or any research funded by a grant or contract or by any other person or government entity. So you have to be the one investing in creating a new product, improving a new process. It can't just be your normal, ordinary course of business items that you're doing. So what expenses can be claimed for this credit? The first one are wages paid to employees that are working directly in the qualified activities, such as engineering, design, and design build up projects, manufacturing as well. Raw materials and supplies that are also used and consumed throughout that process are also a qualified expense. There are also contract research expenses that you pay to a third party for performing on behalf of the taxpayer, regardless of the success of the research or not. These are only allowed at 65% of the actual cost though. And finally, basic research payments made to qualified nonprofit organizations and institutions. These are allowed at 75% of the actual expense. So where we are now with R&D, again, one item is the IRC 174, which I spoke on earlier, with requiring the capitalization of some of these costs. Also for 2024, their IRS released newly revised drafts of the R&D tax credit form, which requires a few additional information regarding the company itself and their business components that are generating the credit to be disclosed. Many of these newly required information and topics are items that should already be documented by the business as they are doing those R&D processes, which are essentially why each process you're doing qualifies for the R&D product, why this specific item that we're trying to improve, this new item we're trying to improve and manufacture, how it meets those 4-part tests. That should be heavily documented by each company, because this is one area that the IRS can scrutinize pretty detailed and need a lot of support for. So a lot of stuff should already be done by the businesses. It's just now on the form going forward, we're gonna have to relay some of that to the IRS up front instead of possibly in an audit down the road.
Exactly. So switching gears here, another credit. So if there's one takeaway, I want it to be this one. This is the low hanging fruit that we encourage every single client of ours to take advantage of. This is the free money that's out there and you just have to capture it. It's the work opportunity credit. It's a federal tax credit. It says here it's available for businesses that invest in American job seekers who have consistently faced barriers to employment. In other words, you go out and hire an employee that's in a certain targeted group that I'll mention in a minute. So all you have to do is go out and hire certain people and you're going to qualify for a tax credit based on the amount of wages you pay to them. This was created a long time ago. It's been extended each year and most recently extended through 2025. As mentioned, it's one of the most overlooked things that we highly encourage you to take advantage of. So what is the work opportunity credit? How is it computed? So for one of the targeted groups, employees that you hire, more on that in a second, you hire and pay wages to them. Generally speaking, you're going to get a credit of 40% of up to the first $6,000 of their wages, $2,400 credit. or potentially 25% of their first 6,000 if they have, based on the amount of hours they work for the year. So you're probably gonna get $1,500 or $2,400. Or potentially up to $9,600 if you hire what's called a qualified veteran. That's based on their first $24,000. Again, this is free money. One important note, these wages that we use to calculate these credits, and this is generally true for all these credits we're talking about, you can't use the same exact wages for every single credit. You're limited to using certain wages for each credit. So what are these targeted groups I mentioned? I'm not gonna go through all of them, but some of the big ones I mentioned: qualified veterans, an ex-felon. Generally, it's someone has been unemployed for a while or is likely receiving some kind of federal benefits. You'd be surprised at the amount of people that you hire that are gonna fall into one of these groups. And here's what you have to do. This should be part of your onboarding process. You should have your HR person or whoever does the hiring and the paperwork. So whenever you have a new hire, have them fill out this form 8850. It's a pre-screening notice. They will identify themselves if they're falling into one of these categories. Then all you have to do is, this is very strict, within 28 days of them starting with you, you have to send it to the Department of Labor of the state. For us, it would be the New York State Department of Labor. You send it into them, the state will certify you, send you a certificate, and say, yes, this employee is a qualified employee, then we can capture their wages. A quick example. So we have Susan, a qualified veteran that's been unemployed. We paid her $27,000. She worked 1,800 hours a year. Jim, also a qualified veteran. He was unemployed for a while. We paid him $25,000 and 1,600 hours, but he worked for less than 6 months. And then Dave, he was a SNAP recipient. We paid him $3,000. He worked 200 hours. You can see here, we paid total wages of $55,000, and under the Work Opportunity Program, by doing nothing extra, we are going to get a federal tax credit of $12,750. That is free money, and you have to go grab it.
As Brian said, the only work that's really needed is handing that form to the employee when they're hired to have them fill out and identify themselves that they qualify.
And an important note, say you have hundreds, potentially thousands of employees. There's services out there that will help you track this and actually help you through this process. They're very reasonable, and they're gonna help you capture that free money out there.
So the last credit we're going to talk about, which is again, another one that's slightly overlooked, specifically here in Syracuse, New York, is the empowerment zone credit. So this is another one that has been extended through December 31st, 2025. It's a federal tax incentive, which is designed to encourage businesses to both operate in economically distressed areas and to hire residents in these areas, which Syracuse, downtown Syracuse and some surrounding areas qualify in this zone. Essentially, businesses can receive a wage credit for up to $3,000 per year for each qualified zone employee. The credit is calculated as 20% of their first $15,000 wages to each eligible employee each year. And full-time and part-time employees can qualify for the credit. As Brian mentioned, though, there's no double dipping with the same wages for, say, the empowerment zone credit and the work opportunity tax credit. So the requirements for this credit, the location, so the business must be located within a designated empowerment zone. The zones are designated by the Department of Housing and Urban Development and Agriculture, and include both urban and rural areas. As I mentioned, Syracuse, New York does qualify as a location. There are certain resources that we utilize when we know a company is in this the empowerment zone and have employees there that kind of type in the address and pinpoints if you're in the zone or not specifically, because there are hard cutoffs. It's not just all of Syracuse itself. The employee residence, so the employees for whom the credit is claimed must also reside within this empowerment zone. And then the employment duration, the employees must work at least 90 days to be eligible for this credit. The 90-day requirement does not need to be met by the end of the calendar year, though. It only needs to be met before the credit is claimed on the employer's original or amended return. So basically what that's saying is if you hire someone in December, they're not gonna meet the 9-day requirement for the end of the year. But they can still qualify as long as they work the 90 days throughout the next year too. So the 31 days in December through the next 60 in the next year. There are exceptions to employment duration, such as if the employee is terminated due to misconduct or also becomes disabled. So the last item we're going to talk about today is the New York State and a few other states pass-through entity tax programs, or PTET. This is a huge planning tool that we have make sure all of our business clients that are pass-through entities elect into. So a little overview on this program. On August 25th, 2021, New York State Department of Taxation and Finance released some guidance which addressed a recently enacted optional pass-through entity tax that partnerships and New York S corporations can elect into to pay for tax years beginning on or after January 1st, 2021. Entities that elect into this program are subject to the pass-through entity tax and have to pay a graduated tax of up to 10.9% on New York State taxable income at the entity level itself, while individual partners or members or shareholders receive a refundable tax credit for New York State equal to their pro rata share of the taxes that were paid at the entity level. Here's just a quick table showing the different tax rates for PTET and how they gradually increase as income increases in New York. So why should taxpayers want to elect into this pass-through entity tax? So the whole point behind the PTET is a workaround behind the SALT cap. So again, back in 2017, the Tax Cuts and Jobs Act limited the deduction for state and local income taxes for individuals to $10,000. So no longer for the vast majority of taxpayers, especially business owners, your estimated tax payments you're paying to New York State of $20,000, $30,000 a year, you're not able to deduct anymore. You're limited to $10,000, and that also includes real estate taxes. So if you have a home, you pay $12,000 of real estate taxes, you're paying $30,000 of estimated payments to New York State, you can only deduct $10,000 total. This is a workaround behind it. So now instead of you paying the tax yourself at the individual level of New York State, the company's paying it for you on your behalf, and the company gets a federal deduction for it that passes through to you and lowers your federal taxable income. So who qualifies for this program? So an eligible partnership, which is any partnership that has a filing requirement under the tax law. It's not publicly traded. Partnership is eligible to make the election, even if it has partners that are not eligible for the credit. We'll get to ineligible partners later on. And also eligible S corporations, which are any New York S corporations as defined by tax law that's subject to the fixed dollar minimum tax. C corporations unfortunately do not qualify because they're not a pass-through entity and they're already allowed to deduct state income taxes at the federal level. An important caveat, while partnerships and S corporations do qualify to make the election, they cannot pass through the PTET credit to certain partners, members, or shareholders, which include other S corporation partners of a partnership, C corporation partners in partnership, and certain non-grantor trusts that are members. Eligible entities must elect into the PTET online on an annual basis. This isn't something that's just automatically done or can be done with your tax return. It's an irrevocable election. Once it is made, once you elect in, you can't back out. The election must be made by an authorized person of the organization itself, which includes any member, partner, owner, or other individual that has authority to bind the entity and sign tax returns. Unfortunately, us as CPAs, we're not considered an authorized person, and therefore we can't make the election on behalf of our clients. The client has to log on to their New York State business account and make the election themselves. For 2025 and future years, or this has always been the case, but for 2025 specifically, the election must be made before March 15th, 2025. So this election hasn't been made wasn't made by March 15th, 2024 for this 2024 tax year. The company is unfortunately out of luck and can't get into the program after the fact. They have a very hard cutoff date with that election. Estimated payments, so as I mentioned, the estimated payments are made by the company itself. They're made quarterly, just like individuals would make. They were due March 15th, June 15th, September 15th, December 15th of every single year. There's also now additional tax return filing requirement on top of the normal New York State return for the company, which is a New York State PTET return. This is filed online through the New York State business website. You have to file the return by March 15th every year. You can file for an extension of 6 month time if needed. Even if, for say you elect into the PTET program, your company ends up having a loss, you still have to file a PTET return. It's just a no balance due return, and it's two clicks of a button of you didn't have any income this year. So how do eligible taxpayers claim the tax credit themselves? So these individuals that are owners of these businesses, on your K1 that you receive, you'll have on your New York State K1 a PTET credit passing through to you. That credit is then input onto your individual tax return. It has to be reported on form IT 653, which is a pass-through entity tax credit. And you have to attach that form to your New York State income tax return. The PTET credit cannot be claimed on group returns filed for non-resident partners. And taxpayers with PTET credits exceeding the tax due for the year may get the excess credit refunded to them. So as you can see, when we go back to that tax rate slide, a lot of our clients specifically that are business clients fall into kind of more of those middle areas where they're paying at the corporate level of 9.65%, 10.3% tax rate and getting a credit to the individuals off of that. But the individuals themselves are only paying tax at roughly 6.85%. So this credit is going to cover most of the time all of your New York State tax. Plus, a lot of our clients we see, because they were paid such a high rate at the company level, our clients are actually getting refunds on top of that. Here's a quick example, just one run through really quick. If there's 1.2 million of PTET income for an S corp, they had tax 6.85%, so tax of $82,200. That credit would pass through proportionally to the 3 shareholders, who would then claim credits, refundable credits on their individual tax return. And then assuming that all of these individual shareholders are in the, say, 32% tax bracket federally, their recognized federal income tax savings are approximately $26,000 by electing into this program than if they had not done anything.
So in other words, you're gonna pay tax in New York State anyways. Let us help you elect into this program and get a benefit for it.
Exactly. New York State's not the only state that is implementing a pass-through entity level tax to circumvent the SALT cap. There are currently 35 other states that are implementing similar taxes. So businesses that are in multi-state environments should be aware of this. We look into this with all our clients that are in various different states. So if there are PTET programs available, we want to make sure we're electing into them. Just a list of all the states here that do have a PTET program available.
So if you do have a question, please note that you can put it in here. Looks like we're probably running out of time, but they will be captured and we will get back to you on these. One important note, again, I thank you for spending part of your morning with us. We did cover some topics relatively quickly. Just want to give a plug to our upcoming tax and financial planning conference next month on November 6th. One day after election day, so that should be pretty exciting. We'll see what is in store for us. So we encourage you to go to our website and register if you haven't already. Doesn't look like I see any questions. So we're going to give you 1 minute back of your day. Thanks again and have a great day.
Thank you.